Welcome Neil and Arthur Mallet to the Regency Capital show podcast,
The Talk
uh,
Exchange, Kavika.
the
It's the
Talk
Talk Exchange.
Exchange. That's right. That's right. Excited to have all of us on today as we get to dive into something a little bit more specific. Um, this is kind of exciting for me because I think it'll be valuable for all of us and for our listeners to help them understand a little bit about the processes that we go through behind the scenes on the investment side, as well as the conversations that we have as a team and how some of those can lead to the execution of certain ideas. And then obviously the clients being able to see some of those ideas come to fruition in their portfolios. So welcome, boys. For those of you that don't know, we've been accumulating some pretty heavy positions in the insurance industry. And obviously, insurance impacts all of our lives greatly, whether it's, businesses or landowners, apartment owners, etc. And so, yeah, it's really germane, I guess, at this moment in time. And excited to talk through this a little bit. I'm going to toss it over to Arthur and see kind of some of the thoughts that you have. And kind of how we go about discussing this internally.
Yeah, so I mean, it was really it's interesting because obviously Neil is, 24/7 has a brain on investments and is always looking at things. But it's always interesting for me specifically as not the investment person, but when we were going through our own insurance renewals for the firm, we were struck by the high cost of the premium. Of course, that was just a confirmation of what we've all experienced over the last couple of years in our own personal insurances, whether that's car insurance or home insurance or whatever we've needed to be insured for. But it was an interesting moment because that sticker shock was almost this moment of, oh, wow, it's like this final lens that I think is incredibly valuable. It's that final lens of, we always do all the due diligence, the fundamental analysis, and then there's that real life filter we put things through. Is like, does this all add up in sort of a more layman logical way? And the answer is yes. Like if our insurance premiums went up X%, but the risk that we pose is not gone up at all because we're doing the same thing we've been doing from an operational standpoint. So that creates this extra float for that insurance company, which is a powerful investment tool that Neil has always been a big fan of from Berkshire, which has a giant float and they do great things. And Warren Buffett obviously is the one in the head of that. But I wanted to just ask Neil a little bit of how, when we get to that point and we had that moment, you had already been really searching and digging into that basket, into that sector, and how you ended up coming up with the names you came up with and what that process was like for you.
Yeah, and to be sure, we've always had a little bit of insurance exposure just because we've had Berkshire. Berkshire's a lot of things. It's a big conglomerate now, but to understand Berkshire is to understand the concept of insurance and float. Berkshire became Berkshire because they write policies, they collect premiums, and on their balance sheet is a reserve, and it's a loss reserve. So the insurance company has to book some giant number in terms of its insurance liabilities, or called float. Now, so long as year to year the premiums that come in are more than the payments that go out for accidents or casualties or whatever, that float is free. It's in fact it's better than free. I mean, it is free financing. And so as long as an insurance company is underwriting profitably, it has this very, very powerful leverage to invest. Now, most insurance companies, will just ladder bonds, high quality bonds, because, one, it's prudent because you need reserves and they need to be there for when you have real catastrophic years. But also most insurance companies, they pay dividends, they pay high dividends, and they're more purely insurance driven. Berkshire, and the secret to Berkshire's compounding is they made profits through the insurance company and they didn't pay it out in dividends. they retained it, and they retained so much that they're then able to take monies that are way beyond any reserves they need and invest in other things. See's Candy, Coca-Cola stock, American Express stock, Burlington Northern Rail, et cetera, et cetera. So the secret to Berkshire and why it's the largest company on earth in terms of equity, assets minus liabilities, it's the largest company on earth. The highest net worth on earth is Berkshire Hathaway, even if it's not the most valuable company in the world. But the secret to that was this sort of compounding, not just compounding earnings, but using this concept of free money, essentially. So we've always had some. Over a year ago, added another one I had maybe many years before. I think of it as a baby Berkshire, much smaller company, Markel. Very interesting group. They really great underwriters. They're relatively small, but they're the 800-pound gorilla in the types of lines they do. They also don't pay a dividend, and they reinvest, buying whole businesses, but also a pretty nice stock portfolio and some bonds. And so from there, we're talking about sort of a bifurcated market, very expensive things, very relatively cheap industries, and all of a sudden, we had very quickly a very perceptible bet in that industry. And so it's anyway something we wanted to talk about because it's big and noticeable enough, if you look at the portfolio, to say, wow, a lot of insurance companies, and I've wanted to talk about it, but it took us more than 6 months to get to where I wanted to get to in terms of exposure. So anyway, very, very timely. Also say before we continue, generally speaking, two kinds of insurance. There's life insurance, which we pretty much all understand that. And then there's property casualty insurance. So I'm not talking about life insurance. That is more commoditized companies that, write policies, and they use actual aerial tables and, do medical checks and all that on their policyholders. Very commoditized business. I'm talking about like the kinds of insurance you mentioned, various lines of business insurance, real and often more complex risk situations, and very big market, and it's not a homogeneous market by any stretch. So all of our companies pretty much focus on that side of it. So as we talk insurance, let's caveat, think of the property casualty side, not not the plain vanilla life insurance side.
That's a nice distinction. Also, I think well said on just explaining kind of the basics of the insurance business model. I think the concept of a float might be a foreign to some people, and being able to invest that money in different ways and helping the insurance company, that's how they become these juggernauts and really profitable machines. Real quick, before we kind of dive into some more specifics on some of our investments, when looking at or analyzing investment or various insurance companies, are you looking at the different types of insurance and lines and products that they offer, just as much as some of the financials and the balance sheet stuff? Or how do you, when you initially look into a company and approach it, where do you start?
Oh, good question. So, first of all, why insurance? Insurance is just one of those areas. Property casualty insurance is one of those industries and areas I think that are always sort of worth looking at or keeping tabs on over time. There's probably 6, 7, 8,000 stocks traded more or less in the U.S. on the U.S. exchanges. Probably 50,000 stocks in the world, covering many sectors and many more industries and sub-industries. Most of those industries, most of those companies, therefore, are not really keeping tabs. It's not worth keeping tabs on or always considering for investment, either because they are too hard to understand, or as often as the time there's no discernible long-term competitive advantage. I don't follow. I'm sorry to pick on this company all the time. I just use them as an example. As you know, we own Costco. I don't follow Macy's. I don't follow Target. I don't follow a lot of just
Neil,
about
it's
most
pronounced
retailers.
Target, Neil.
Target. Okay, I don't keep tabs on those because they are not companies that I think have a wide moat, or they don't have a durable competitive advantage. In insurance, especially property casualty side, you do have pretty interesting moats, very interesting competitive advantages, especially over time, as insurance has gotten bigger and more complex and data has gotten better. You see some of these companies, the ones that both have size, but more importantly, have really good underwriting discipline. The cream kind of rises to the top, and their advantages get bigger and bigger over time. I know we'll talk about Chubb, but a company like that's big, but then they're also in these very specific insurance lines, and it's really hard for another company to come in and compete with them. They either don't have the balance sheet, or they don't have the data, years and decades of information. They don't have that informational advantage. And then oftentimes when companies or investors get in that business, because insurance, like anything else, is cyclical. And when interest rates are zero and people are making money hand and foot, and every hedge fund manager is creating some kind of Bermudian insurance company, and they start selling, insurance and reinsurance. Those are sort of the, very, almost insurance tourists. And when the market turns from a soft market to a hard market, they fall away. Some of those companies go under, but the real steady, better players, not only survive, but they thrive, and they thrive on the.
I wanted to touch on that just because it's a great point and a salient one, because I think the narrative around insurance, especially property insurance as it pertains to all of the extreme weather things we've been seeing, you talk about flooding, earthquakes, the things that have happened, the condo in Miami and all that stuff. The narrative around insurance is actually like, these guys are going to have to pay out such a high percentage more than they used to. So I think the general consensus for the average person would have been to avoid insurance because, hey, man, these liabilities are about to come. And we sort of see this pattern happening. But I think you really articulated a great point of it's still necessary. It's a necessary thing. So the ones who are the best at it and are more diligent and practiced and have better information and are just better at the overall job of underwriting will then just rise to the top even faster. It just eliminates that middle to the bottom much quicker than it would historically.
Yeah, so very, very wide range of outcomes in terms of like what companies can grow and how successful they are. All of them enjoy, and another reason for this competitive advantage is, insurance is something that will never go away. People always, and companies, institutions will always have various risk exposures that they want to mitigate or eliminate. And a lot of insurance is kind of, it's written in, or it's law, right? If you're Jeff Bezos and have well over $100 billion in net worth, guess what? He has to own auto insurance, even if his own net worth is bigger than just about any insurance company out there. He's got to go to a State Farm or a Geico or whoever, just like everyone else. That's probably the easiest example, but think about the world of finance and how big that is, and how many things are financed and how many things are collateralized. And what lender is going to lend you a bunch of money to go buy, could be a piece of real estate, could be big ship, whatever, without you having a lot of insurance at the borrower, because they need
assurances.
Yeah, they need assurances as well. So and so as you think about that, the problem, it's always there. The solutions are sometimes very expensive, and in some years they're very cheap. Again, it's cyclical, hard market, soft market. But as a customer, you also it's very much a competitive market, meaning there's no reason to stick to one insurer unless it's earned by merit. right? You don't care who insures you, just as long as you get what you want, but you also have to have reassurance that that company's going to be there. So
Right.
what a lot of these other companies offer, the strong ones, not only offer higher, better credits, they're better, they're just higher percentage, higher probability that they'll be there at the end of the day. But these insurance companies can also have a lot of informational and analytical advantages where they can come in with the best package, the best policy or sets of policies. It's never just one policy, and maybe even price it better because they have better information. So, you put those two together, and it's a pretty formidable offering that is really hard for another company to come in and just compete and take market share, even if they're big and have deep pockets. So, again, always worth looking at. And so that and many other industries worth looking at. Always worth looking at, but seldom are they investable because of price. Price matters, or at least to us it matters. So we could look at something for many years and even decades and not find an opening. And we'll see if we're right or wrong ultimately. But I think the last year and a half has been a pretty good time to get into the insurance business, so to speak. And that's what we're doing.
Yeah.
We're buying stocks. We're getting into the business. We're part owners of these insurance companies.
Can we talk a little bit now about Chubb specifically? So that was, this obviously it has a nice story on the other end of it, because of course, it was later discovered or disclosed that Berkshire Hathaway, Warren Buffett, had bought a significant stake in Chubb. So can you go through that process of selecting Chubb? Obviously, we went over the more general process, and obviously that applies to Chubb as well. So that's built into to what already exists and what you were already thinking. But just because we say this often as obviously as a compliment, but we think of your mind as a value investor, there's a lot of similarities between that and the Buffett style approach to looking at companies. So it was almost a very fun exercise with obviously a great outcome. I won't call it luck, but obviously there was some luck involved. And, Kawika wrote a great piece about the importance of luck very recently. But how is that process, and just trying to go through that and then finding out and realizing, all right, I was on the same page as Warren Buffett, which must feel good on a personal level, but also I think it's a great example of how aligning your process of going through these, looking through these names aligns with what we are trying and striving to be, which is using that value investing hat, looking for the right companies who have those moats and all those things.
Yeah. So we were, I think we're still accumulating, Markel. So that was like the second insurance company. About 9 months or so ago, news release that Berkshire got a waiver from the SEC not to disclose a certain company that he was buying more and more stock of. Those don't happen very often, but because every institutional investor at the very minimum quarterly have to sort of show their hand in all their holdings, you have to show your buys kind of right away if you're acquiring more than 5% of a company. So once you get over that 5% threshold, you have to tell the market. Sometimes companies, bigger investors can get a waiver from the SEC because they argue, hey, it's not fair because once this news gets out, I'm not going to be able to buy all that I want to buy. They gave him a waiver for that. So and that waiver continued for 3 straight quarters, more than that. So 9 months plus. There's this mystery. Annual report came out, and they had to categorize it somehow, and it was financial. This was early on financial. So the market just knew that it was in the financial sector. So we're buying Markel, and it took about 10 minutes to figure, or at least for me, 10 minutes, just again, knowledge is somewhat cumulative, and the players, and kind of figure out, okay, probably would never invest in these. I think there were a lot of people on TV. Most of them were pointing to like European banks and things like that. I was like, he's not buying a bank, for a lot of reasons and obvious reasons.
Neil Rose put on his Warren Buffett helmet and
no, just I mean, as you know, the sort of the spiritual chairman of this company is Charlie Munger. So I sometimes think, what would Charlie do or say? And both of them would say, forget about all these companies. You're really looking at, a set number of companies. Yeah, it took 10 minutes to figure out it was Chubb, but then I hadn't looked at Chubb in a long time. And for a lot of reasons, just a lot other things looking at. It had a premium, things like that, and spent the next couple of weeks really looking into Chubb and saying, wow, this is I'm pretty sure this is the company. But I don't care if it is. I want to buy, and I'm hoping that it's going to take us maybe some months to accumulate the position we ultimately want. But I hope that disclosure doesn't come out before we get what we need. So anyway, yeah, it took many months, and obviously the announcement comes, you get a pop. Again, I don't care about that, but I do care in the sense that that news about some secret stock did two things for me. One, it kind of got me to Chubb, or reminded me, hey, go check out Chubb, this insurance company you really like. And two, it kind of gave me more confidence to maybe increase the overweight beyond what I thought I would do or want to do. I want to do more, and for a lot of maybe irrational reasons, kept it lower or slower, growing that sector slower than I really wanted to. But when I found, oh, Buffett's buying financials, and I think, and he's very much overweighted financials in general. But yeah, we can pick up some more insurance companies. So yeah, Chubb was the first. I said, I thought there was a distant second in probability anyway, that it might be Aflac, just because Buffett's made a lot of money recently, recent years, buying Japanese companies, but doing it in a very smart way. Cheap, mega Japanese companies that are kind of perennially cheap for management reasons and reasons that are strictly kind of uniquely Japanese corporate culture. But Berkshire's big company, so they get to borrow in yen terms in Japan at like 0.5% to 1.5%. And he's buying these companies that are, 6, 7, 8 times earnings and with a 5% dividend yield. So he's financing these 5% income streams, with growth, at average about maybe 1% a year and getting long-term debt. So I thought maybe he's doing that with Aflac, or using Aflac as a platform for that, because people don't know this. We all know Aflac. It's kind of a household name because they advertise so much. But Aflac is, 3/4 of the business is in Japan. Aflac is huge in Japan, and they're doing mostly supplemental insurance, cancer insurance, things like that.
I definitely didn't know that. I was pretty sure
Yeah.
that Duck was just doing very well here in the
Yeah.
US.
So
I was gonna
Aflac,
put the Aflac flag in Alabama because of how much they support Nick Saban and Bryce.
yeah, I mean, they have a, they're a big company, big presence in the US, but the US side is so small compared to the Japanese side. And insurance in Japan is really profitable. I've never owned Aflac previously, just because it was always really expensive, because it was so profitable a business. But I thought, oh, maybe he's using Aflac as a vehicle to borrow even more money in yen terms. And anyway, but didn't care if he was buying it or not. It looked cheap enough to just get a little bit of, and we still have it. But yeah, so I think insurance is a great business. I think this more or less could be longer term holds. Again, so long as management stays the same, at least from an attitude standpoint. Insurance is not enough. You really need good, disciplined people. Most insurance companies, I'd argue, even big ones, are very pro-cyclical. When the pricing is the worst because there's a lot of competition, and premium rates are pretty low, et cetera, et cetera. A lot of these companies will just do more of it, and kind of go with the flow or go with the crowd. And sometimes it's just because they're paid on volume. The better insurance companies are often paid not year to year based on profits. They're paid more in terms of longer term stability and growth. So the incentives are there to write profitably for the long term, even if it's not writing so many policies in
You're referring to underwriting discipline as opposed to quantity. It's really making
Correct.
sure that your
Correct.
premium is something you'll get to keep in your pocket as opposed to having to
Right.
pay out in the next couple of months,
Right.
and then it's all for nothing. It's just a rotating door.
Yeah. So kind of through insurance, among other industries, really came to understand more, incentives. If you look at a management's compensation structure and it's tied to growth, or it's tied to size, or even just tied to profit, like short-term year-to-year profit, you're going to get a certain behavior and certain, they're going to be sort of pro expansion, pro more. When you have management teams that have real skin in the game, their owners or big owners, but their compensation structure is long-term focused and it's defined more in terms of return on capital, return on investment, underwriting, success, you get a different behavior, and those are the ones that are kind of contrarian. So for the better part of the last decade, they're not riding as much as they could have. They've got a lot of firepower and dollars and money to deploy, but they didn't. They showed restraint. And now that the market is hardening, meaning as we're experiencing, these prices are going up, these renewal rates are not up 3, 5, 10%, they're up 20, 30% in premiums. The weaker players are falling off because they're engulfed in this thing called rising interest rates and more expensive money that is crippling a lot of the financial sector. The stronger players come in, and now they've got sort of the market more to themselves than they had before. And so if you can get all that, the timing wise, and you're not really paying for that setup, and these companies, take Chubb for instance, I think Chubb's 11 times earnings. It's very inexpensive considering it's growing. It has been a secular grower. So good weather, bad weather, they've done pretty well. I think they'll do even better going forward. And you're not paying for those expectations. It makes all the sense in the world. So,
Well, I think it's a great view of another part of the equation for you, which is tying, management incentives to behavior, to how a company is run and what's going to drive their balance sheet forward in the future, and how that affects the investment and longer term. So again, it's that idea of that value investing hat, that longer term holding, which is something, you always say this, you're buying a part of a business, you're not buying a stock, it's an actual ownership stake in a company. What companies do you want to own? And certainly you want the ones where the management is incentivized to do this smarter thing for a longer period of time versus what trading, day trading, or sort of the short-term momentum-based things, which is, well, if they're incented to grow it very quickly in the next 6 months, then maybe a stock price as earnings hit for 1 quarter, 2 quarters might have a pop, but it's a long-term risk or detrimental behavior for the long term of the company. That's, I think, a really important distinction in how we invest in things and the names we choose, especially as we see some things that will pop on the short term. And there's always that FOMO of the general investor of like, oh man, I read about this, I wish I was already in that. It's like, well, in some cases, those short-term benefits come at long-term costs that,
right.
We won't necessarily see for a little bit, but we want to be in a position where we're not worried about that. It doesn't have to be a timing thing, because you've also always said, and the idea of timing the markets, trying to time the markets, the fastest way to end up with no money. It's just, you'll always end up buying high, selling low, and that's just the only guarantee in investing if you're just trying to trade your way into or out of anything.
Yeah, been there, done that. I mean, there's like insurance, there's other areas. We talked, one of our episodes here was about, real estate. Real estate's always worth looking at. And you have, publicly traded REITs that have some pretty interesting stuff. And like insurance, real estate is not just one real estate market. It's regional, it's by type. You get residential, and then even commercial. Is it strip mall? Is it hospitals? Is it industrial properties? I spent all of last night researching an industry that I still haven't figured out a way to invest in it yet, but marinas in the US, right? You talk about a really interesting niche real estate thing that
sounds like a real bang up good time. You didn't invite us to your marina research party?
well, marinas. You do have some groups out there that are buying marinas. They're mostly mom and pop owned, and I mean they're just cash cows, and there's really high barriers to entry. Anyway, but then you look at those niches and everybody else, and just about all of these companies, their incentives are just to grow the portfolio. Like they're paid based on size. So if you're a real estate company buying strip malls, your compensation is directly tied to how many square feet you
Square
have
footage.
in your portfolio. Whether or not you're actually making money or doing things responsibly, mitigating risk and all that, that's secondary. You're paid based on size because all of these people use the same compensation consultants, and they say, well, your peer group is X, Y, and Z because of how many square footage you have. That's why we almost never do these securities because it's just very pro-cyclical. It's not something that you can look at and say, I trust this company is going to do the right thing over time, and I don't have to worry about getting too drunk or too greedy or too, whatever, where they become irrational and lose money.
I don't know. Getting drunk at a marina sounds like a pretty good time. We should maybe do some of the research there. We can go to Marina and just really.
I just love these win-win-win-wins, right? So Chubb, right? So in these one pagers, sort of see a lot. Not just its historical price over time, but year by year numbers, and a lot are per share numbers. So that's important too. Is investors will look at a company's revenue, earnings, etc. But if the share count is growing at a faster rate than earnings or revenue, then those statistics are not very meaningful. So, so always kind of look at things like, and this is Chubb's, right? This line here, common shares outstanding. You can see that over time the share count has expanded because they grew and acquired. And in fact, Chubb itself was acquired in 2015 by Ace Limited. Ace Limited bought Chubb but retained the Chubb name because Chubb is such a premium brand and frankly better company. So very smart on them to sort of buy themselves or marry themselves into a much better situation. But a really good CEO. He's still on. But I look at some of this stuff. So the common shares outstanding, you can see, their various statistics, loss ratios versus premiums held, and ultimately it comes down to, okay, what percentage of the premiums do they have to pay out in losses or to policyholders who make claims. You want it under 100%, right? So you collect $100, you don't want to give up over $100 in losses. You want to maintain that underwriting profit so that
feed that float.
The money in the float you can keep investing. So a company like this, okay, so they bought you saw that big jump in 2016 with the share count. Again, that's because of a big merger. But since then they've been actually reducing shares. So some of those earnings, they're not just buying investments and bonds and et cetera. They're buying common stock from current shareholders. So the number of slices in the pie is shrinking, but meanwhile the pie itself is growing, and that's where this net profit number comes in. So, if you compare it to 2016, Chubb now makes roughly double the amount of profit. With fewer shares. So your earnings per share, which is this line here, okay, your earnings per share has really increased from $10 a share roughly in 2016 to this year it's going to be almost $22 a share. So pretty significant. And if you believe that over time the market is a weighing machine, not just a voting machine, you see the stock price really start to match the realities of the business. So if a business grows earnings and earnings per share specifically over time, the price will take care of itself. So again, we've seen a lot of growth, and we've seen the price go up. It hasn't gone up a lot as much as many industries, but if you kind of look at what's been done, you could almost argue that earnings have grown faster than the price for quite some time. So whereas most industries, the PE price to earnings ratio has gone up and gone up significantly, double, even triple. If you're looking at a lot of tech companies, the insurance business, they've stayed flat or even gone down. So from a multiple standpoint, they've gotten cheaper.
And that, I mean, is that another, that's more evidence of good management in a sense of if they see on their end that the price of their stock isn't increasing at the rate of their earnings, and it makes sense to buy back stock. And that's a smart allocation of capital,
Right.
because it allows them to become more profitable without having to actually push the envelope or do some of those volume, more aggressive revenue growth strategies. It becomes an internal balance sheet growth thing through prudent management and asset allocation.
Yeah. And yeah, share buybacks by itself. I mean, it's a hot topic, not just investment wise, but political. I think people really simplify the issue, and it's bad, right? We're taxing now stock buybacks in this country. Stock buybacks themselves are neither good nor bad. It's are they doing the right thing? And sometimes the right thing to do from a management standpoint, fiduciary standpoint, is not to buy back stock, but to pay dividends, or to reinvest in the business, or pay down debt, or just to hold more cash and more reserves. And then sometimes, and probably not as frequently as you might suspect, just looking at what everyone does in the market or all these companies are doing, sometimes the best, safest, and most fiduciary thing you can do as management is to actually take those profits, use some of it to buy back your partners, buy back other shareholders.
Right.
And again, very nuanced point. I'm categorically believe that not only are buybacks not good or bad, but I will say most managements, most companies are not good at buybacks. Again, that is also pro-cyclical, right? So when times like this, the last couple of years, stock buybacks have reached record highs, and but at a time where stocks are also record,
they're all
etc.
very expensive. They're buying their own sauce at the highest possible price.
And in a lot of, and this may be a secondary, a lot of them are doing it not actually for economic reasons. They're doing it because they're paying themselves so much in stock, and so they're diluting the stock, and then they got to go buy stock to, sort of
It's all part of compensation as opposed to tied to a profitability equation. And
so again, another reason to look at proxies and the compensation schemes and all that stuff. But anyway, so we look at this, and just again, this is so rare that you have one of these industries where arguably the business and the companies in it, especially the real stars in that industry, are better businesses than they were 5, almost 10 years ago, and the price isn't reflected in that almost at all. In most cases, most industries, if the earnings have grown, let's say double in the last 5 or 10 years, the stock price has gone up quadruple, or 10 times.
And that's certainly the general narrative of the financial news and stock market news is really, obviously it's leaning on those high flyers and all that stuff that have come through, especially since COVID. But I think it's always an interesting conversation. Why I think it's great that Kawika brought it up and wanted us to focus on it is the idea of, there are other industries that are worth looking into, maybe not as sexy or headline stealing as some of the things that are going on, but it's always reassuring for me, obviously, and it's always interesting for me to hear you talk about what drives you to look into certain things and what has you, because the world of investment seems very large. And as you mentioned, obviously there's a whole chunks of that of the marketplace that, we don't really consider investable for various reasons, but it's still such a unique opportunity to see the way your vision gets focused and how your brain is looking. And also, for us, like I said, it's great to see that you do have that similarity to that Munger Buffett, world a little bit, because we use that analogy, and you're always a little bit shyer about it because obviously you're your own person. But, for people who aren't into the investment world, it's a name that people can understand and sort of have a general idea. So I think it's great that this opportunity and this actual event happened as almost like a highlight in a lesson of one of those things.
Neil, you want to stop sharing before I kind of wrap us up, as ironically, I have to go have lunch with some people in the insurance
Insurance business?
industry, in the local insurance industry.
Right.
No, I mean, I kind of echoing what Arthur was saying. I think it's a really fascinating discussion for a lot of reasons. First and foremost, I think just getting a really deep look or insight into kind of our processes and conversations that we have in office. Some people are really interested in some of the specifics of the portfolio and what goes on behind those scenes, and I think this was a really valuable conversation for them. I mean, we talked about, you know, management incentives. There are different layers of kind of how we analyze the moats or the durable competitive advantages, as well as some of the fundamental analysis that you just showed too. So just a lot that goes into it. And then, yeah, it's just a reminder that these are kind of real world businesses and real world issues that we love talking about and talking to our clients about. We've got a lot of small business owners that deal with this, a lot of real estate people and landowners, property owners as well. And so, you know, it's just really ripe, I guess, for having this discussion, not only with them, but internally as well. So appreciate your guys' time.
Yeah.
Anything else to add, boys?
No, I just, again, like timely, I think we'll do this more in terms of when we're overweight something, you know, you have to sort of address, you know, I guess material bets or investments that we're making. And some of these we could be wrong. And so, you know, the next insurance discussion, if we have one, you know, might be rubbing our nose in the mistake that was going long insurance. And I, you know, don't want that to happen. But if this doesn't work out for whatever reason, it would be fascinating to and worthwhile to talk about what happened, why we were wrong, what do we learn from it. I do think, again, we're overweight, but it's not like everything's hinging on this. If we're wrong, this isn't going to kill performance necessarily. But again, it's a material bet. You know, we'll make them from time to time, but not very often. I can't think of the last time, or I can't think of more than, you know, a handful of times over many years that you know, had this kind of conviction about a certain industry group, and we'll try to be diligent about doing that if and when they come.
But I think people appreciate the discussion and the thought process behind that, the conviction, and then also just acting on it and executing, you know, and like you said, we could be wrong on some of these results, and that's okay. We're sticking to the process, and time will tell. So we'll revisit that.
Well, it's great talking to you guys.
Till the next one.
Thanks.
All right. Adios.